The Hang Seng is down 170 points as we speak.
Individual conversations with customers were a lot more positive than what the overall macro commentary was, and that we're basing it on that.
Giving a 14-day mandate to the adjudicating authorities in terms of either accepting or rejecting an IBC plea.
The question is, can the Nifty outperform the global indices today? And I think, yes, that could be a case actually for the Nifty to go ahead and outperform.
Flows in general are tilting towards emerging Asia.
First take on the index is down almost 65 points.
We've seen a shift in inflation expectations in the US. That is starting to come down.
Does not seem to be too much of an upside in India for the immediate term.
Opening date of this particular FPO is on Jan 27th. It will run up till 31st of January.
For us, the furloughs came in at about 1.5%.
Down 12 points on the Nifty. We've snapped a two-day winning streak.
Net interest margin is at 10-quarter high. So return ratios are one of the best in last 3 years.
We're seeing two drivers for growth. One is the continuing work on digital and cloud.
Pharma majors have approached Bombay High Court for clarity on free samples and gifts to be considered as genuine expense under GST.
For now, we are seeing a slight recovery from the lows. The Nifty is down 40 points.
Well, that was the day so far. Hello and welcome to a fresh new edition of Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me over the next 60 minutes, my colleagues Reema and Nigel. Guys, hi. Hi. And even as we begin a new show, we've got more numbers which are coming through. Havells has reported third quarter numbers, and let's just refer straight to it. You've got the EBITDA number on your screen, which is down about 4%. These are actual comparison numbers, but against expectations, we'll have a set as well. EBITDA margin at 10.3% as compared to 12.1%. That is on a year-on-year basis. Profits have come in at 284 crores. This compares to 258 crores, which was the CNBC-TV18 poll. So this is a slight beat on the revenue as well. I think it's a beat, 4,120 crores as compared to 4,055 crores. That is one of the sort of top names in that space, which is perhaps the most widely owned institutionally and otherwise well-tracked F&O name, and the numbers broadly seeming to be better than what was expected. So 0.5% higher is what we have on Havells. It's picking up pace. We'll have more details with our research team in just a bit from now. The market as well, if you can have the Nifty up, is taking a bit of a dive. I mean, once again, so this is not the first time. We've had many of those, but look at that. It's very clear. Just started in the last 5 or 7 minutes, but it's a sharp one. We were down 30 points 5 or 6 minutes back. We're down 65, but it's been that kind of a market. No real trend or no real forceful move in either direction, but holding with small cuts. I mean, 60-65 points on an index at 18,000 is not large, a third of a percent, but it's been that kind of sort of session since the morning. Small caps perhaps are markedly kind of underperforming. The small cap index is down. Market breadth consequently is a little worse off. FMCG, consumers and real estate are three areas, top down, sectorally speaking, which are the top losers. On the index, I mean, we're not really, actually it's an inside day. You've got the high is lower than yesterday's high, the low is lower than yesterday's low, and we're somewhere there. So on the way down, the recent low of 17,853 is the big reversal level. It's of course some distance away. And on the way up, the resistance comes in a little higher than yesterday's high. Yesterday's high was 18,181, 18,182. And the resistance comes in at 18,192, which is basically the 38% retracement of the full fall from 18,887. So, I think the numbers, of course, have been well detailed for a while. It's just that we're waiting for a bit of a break. We got that break last 2 days, 200 plus points. And today, we got a bit of a quiet session on our hands. Reema, hi.
Hi. So just to take stock of the market moves and the individual constituents, FMCG is the big drag today, right? The Nifty FMCG index is down close to about 1.5%. Where Asian Paints missed because the volumes were flat. The street was expecting a volume growth of 5 to 6%, so that's under pressure. HUL ahead of numbers today is lower in trade, and the other one is Titan, where UBS downgraded the stock to a neutral, and they lowered the target price to 2,600. Talking about the earnings reaction, pretty stark, right? On one hand, IndusInd Bank is selling off despite seemingly good numbers. Rallis, where there was a miss on the back of weaker export performance, Rallis is down 7% now. But on the flip side, Persistent is up 7%. The numbers were good. They were slightly better than Street was anticipating, but the 7% reaction is also, the starting point from where the IT companies were, right? They were beaten down, they were sold off aggressively last year, which is why you are seeing that exaggerated up move on the way up. Week to date, HDFC Bank continues to outperform peers. Today as well, HDFC Bank is higher in trade, and this week it's outperformed its closest peer, ICICI Bank, by close to about 4%. Nifty, Nigel, is exactly at that 18,100 mark. It's the expiry as well. So the last 1 hour is going to be crucial. What are you tracking?
Well, that's right, Reema. Just one point on Havells first. The numbers are looking good because the largest part of their business, which is the cables business, well, that's done very, very well on the operational front. If you look at the operational performance, the top line growth is in that vicinity of close to around 15% approximately. But the EBIT number, well, that's gone up from around 125 crores all the way to around 163 crores. And that's where the big beat is coming in. Because on the switchgear business, well, there is still some margin pressure out there. Even if you're looking at the lighting and fixtures business, well, there is some compression out there. So what's done well for them? You have the cables business that's done pretty well. And also you have the electrical consumer durables business. Both those two have done well. Lloyd's continues to deliver a bit of a loss. So the beat has come in basically from both these two. And to give you a number, well, the cables business contributes more than a third of their business. So cables has led the way, and the ECD business as well has done pretty well. We'll get more details on that front, but that's why I think the street is pleasantly surprised. Despite having a loss on Lloyd's, it's not that big a deeper gash. Well, let's focus on a couple of levels. Then you have the Nifty's low today. 18,064 odd, that's the day's low. We have bounced off that level. And the Nifty Bank as well, we're almost at the lows of the day. And in the last 15 minutes or so, the reason the Nifty went low is because of the Nifty Bank. That's taken a bit of a dive. What are the levels you're looking at? Well, 18,150 call, that's been getting written all through the trading session. And the premium out there has come down to around 15 to around 20 rupees odd. On the downside, the 18,000 put, the premium had come down only to around 10 rupees. But you're doing a rough average, and the average was around 20-25 rupees odd. So the important that the bulls can defend this 18,080 odd mark on the downside, 18,070, 18,080. That's going to be crucial. Otherwise, in fact, we could see a bit of a sharper downtake in the last 1 hour or so. Reema?
Okay, thank you very much for that. Let's tell our viewers what we've lined up on closing bell this Thursday afternoon. Persistent System fires up on delivering stronger margins, bullish commentary. The management tells CNBC-TV18 it remains confident of closing FY23 with at least a 30% revenue growth. Sale is surging in trade on the back of an Equirus note. More details lined up. Asian Paint trades in the red as Q3 numbers come below estimates. A complete fine print coming up on the show. HUL L&T Tech will be reporting numbers in some time from now. Key expectations lined up on the show. We'll be joined by Dinshaw Irani of Helios Capital to discuss the outlook on the markets.
Okay, that's an interesting lineup as always, and we'll get to that. But how should you position yourself in the last hour of trade? Mitesh is with us to tell us exactly that. Mitesh, I mean, kind of a tough session to read, right? With these sharp moves, but limited moves, 30, 40 points very quickly up and down. But what would you do?
So, Prashant, I think, one good thing is that we haven't been selling off like we used to do a few days back. And, I think 18,050, 18,030, 18,000 zone still remains a support area. Till we break that, I think that fear is not there. But yeah, I think, today it seems like more of a consolidation day within a narrow band. And I think now yesterday's high becomes an important intraday pivot. So 18,175, I think we've taken some profits on the long position, but if it starts getting past 18,175, we'll add them back and then look for 18,250 as the target, and then eventually if it breaks, then higher levels. So in slightly wait and watch mode after taking some positions off the table, but we're still trading with long bias. I have 2 buy calls right now. ONGC is something which is making a fresh high, so that's a buy. Keep a stop just below levels of 149.5. Look for 156 as the target, and Polycab is another one. That's a stock which is doing very well. So that's a buy with a stop at 27.50 for targets of 28.50.
Okay, all right, Mandesh, it's going to be an exciting last 1 hour, so we'll keep coming back to you. For the time being, we have managed to defend that 18,080 odd level, 18,075, 18,080. That's a crucial level on the downside, and we're very close to that one. But let's focus on a couple of numbers. Havells, we did a rough check out there. Sonal joins us to help us out with how she's reading those numbers. Sonal?
Well, good set of numbers, Nigel, and that's the reason we saw the stock spike as well. It was definitely a beat as far as margins are concerned. Revenues also higher than the poll. So this time around, revenues have grown by around 13% at 4,120 crore rupees, which was better than the expectations of 4,055 crore rupees. Now, the company has been focusing a lot in terms of distribution. They have taken some steps to increase their rural penetration as well, which is just around 8 to 9% currently. So that is something which must have aided their top line as well, this push coming in from the rural space. Apart from that, as far as margins are concerned, 10.3% versus an expectation of 9.3%. That is higher, but still it's lower on a YY basis. And the management had told us earlier, back in the day, that normalized margins will come back for the company from Q4 once the inventory issues come down as well. If we look at what is done well in terms of their segmental breakup, they have seen revenue growth in switch gears. There's cable, which is done as well as well. In fact, even Lloyd has seen a growth in terms of revenues. However, Lloyd continues to be a pain point as far as profits are concerned. We did see an increase on a YY basis in terms of Lloyd losses this time around, but the good part is it has come down on a quarter-on-quarter basis, and this is a segment which has been a key concern for the investors as well. But there as well, a quarter-on-quarter decline in losses is something that the street would like. Overall, as I said, good set of numbers, and that's why we saw that spike. Management commentary will be very important. One, on their rural penetration and distribution plans. Second, on Lloyds as well. What are they doing to curtail these losses? And the normalized margin guidance that they've given, that in Q4 it will come back to normal levels, whether they are on track. And in terms of inventory as well, whether channel checks are in tandem with the previous or pre-COVID levels as well or not.
Thank you very much for that, Sonal. That's Havells for you. Another big mover today has been Persistent Systems. While Q3 numbers were good, revenue growth at the upper end of their guided band, margins expanded, the street was working with flat margins. But what really fired up the stock was the management commentary. Now, the company has delivered a 3.5% revenue growth, and this is despite 2 to 2.5 percentage points being lost due to higher furloughs and the seasonal weakness due to holidays, which basically means that otherwise the company would have reported a top-line growth of 5.5 to 6%. Very strong. 2, we spoke about the margin improvement in Q3. The company seems to suggest that these margins will stay, and their aspiration is to improve margins from here on by 200 to 300 basis points in the next 2 to 3 years, right? So in a way, he was indicating that these margins would be the base going forward, and that also is a positive. Remember, most IT companies' margins are trading below the post-COVID high margins. In 1 year post-COVID, everyone saw a big surge in IT margins because they were saving up on travel, wage hikes were not given. But Persistent System has been consistently improving its margins, right? And the company is aspiring for more. And finally, even on commentary, right? General bullishness, the deal wins and the outlook, the pipeline was all very positive. So that's the management commentary which has gotten the street very excited. Listen in to this, the company's executive director and CEO, Sandeep Karla, and what he had to tell us in an earlier interview.
Sharp drop-off that you're seeing is pretty much due to the seasonal furloughs that we see. If we look at the furloughs this quarter gone by, for the industry, it is a little higher than what it used to be in the regular terms. For us, the furloughs came in at about 1.5%, and it also contributes towards lesser number of working days in the quarter due to Thanksgiving, Christmas, and other holidays, both in India and the US. So overall, put together, roughly about 2.5% is roughly the impact because of these, both put together. As far as the top client is concerned, this is a planned ramp down of certain product lines that we have been working on. And this started last quarter. If you look at it, there was a sharp decline in the last quarter. Part of it is the tailwind the headwind that we are seeing in this quarter. As far as the overall revenue from the top client is concerned, we are pretty hopeful over the next several quarters, we'll see a sharp reversal towards the upside in the top customer as well. So our aspiration is to stick to this, at least for the near foreseeable future. And as a company, our aspiration over the longer term is to take it up by 200 to 300 basis points.
Okay, all right. So that is Persistent. Management of the stocks, of course, doing very, very well. Devin Choksi of KR Choksi is joining us now to take some questions. Devin, good to have you with us here. Thank you very much. If you have a view on, Persistent or Asian Paints or Havells, which is just reported, I don't know if you're actively covering any of these, but if you do weigh in.
Hi, Prashant. Good afternoon. I think Persistent, along with many of the mid-tier IT companies, have been reporting, stronger numbers, and I think this quarter is no exception. they have probably, I think, reported one of the smartest and better numbers across all three verticals. So in my viewpoint, I think given the kind of strength that they are exhibiting in form of executing the business in each of the three verticals, at the same time, I think winning the newer contracts above $5 million customers, which on a sequential basis as well as on a YOY basis is, I think, on a smart rise, gives, I think, a good amount of clarity as far as the revenue visibility is concerned going forward. And given the kind of, I think, the execution visibility that one has, I would like to believe that company would be on a relatively stable wicket as far as, I think, the margins are concerned going forward. And I think that should possibly give them slightly advantage. Maybe I think the stock is also trading in the vicinity of around 25 times price earning on a forward basis. So to an extent, I think one can argue that yes, I think there is an element of upside available around 20% in this particular stock from current levels.
Okay, Deven, do stay on. Nigel, you want to tell us a little bit more about SAIL and what the Equirus note is all about?
Well, it's shining today, and that's because Equirus has gone ahead and increased its target price around 140 from around 90 rupees earlier. So they've upgraded the stock out there. They say that SAIL, well, that's the top pick from the sector because JSPL has already seen a bit of a re-rating post the recent run. And for Tata Steel investors may not be very enthused because of its European exposure. And we know Europe is in a bit of a trouble spot. They've mentioned a few points, so let's run you through them. One is, it's a proxy play on higher iron ore prices. They believe that iron ore prices will hold in this vicinity of around $110 odd, and we know that Tata Steel and SAIL, they're getting all their iron ore from their own backyard. So higher iron ore prices doesn't really negatively impact them. In fact, it gives them a bit of an edge. That's point number one. Second factor is they're saying the EBITDA number for FY24 it should clock around $2 billion odd, and that'll be a good number. Even if things get a little bit wobbly, they believe that that's the base case. They'll manage to go ahead and do that. They're saying that SAIL is not functioning at optimum utilization level. So as volumes pick up, operating leverage will play out. And as we know that out of the total other expenditure, the employee cost is bulk of that, which will not go up, in a drastic manner. So by higher volumes itself, they can save closer around 1,800 to around 2,000 rupees per ton. Finally, the biggest fear for SAIL over the last many years is they make money, then they pile up the debt. But they're saying there's no notable big capex that's on the cards, at least till 2025. So on that front, they are saying that the balance sheet will look far better. Put all this together, and they're positive on the stock, and the stock is doing quite well. Deven, we have heard this before. SAIL is going to do well. But valuation-wise, it doesn't get that multiple because every now and then something or the other goes wrong. What's your take on the stock at around 90 rupees?
Well, I think since the commodity prices are turning favorable for the steel companies, particularly I think India domain is producing higher amount of demand given the kind of infrastructure thrust that the government has put across. I would like to believe that I think there is going to be margin improvement because of the improvement in the price in this particular period now. Maybe the December quarter may reflect partly to it, but I think January to March quarter and thereafter, one should be seeing a higher amount of margin growth coming in. And that could possibly add to the volume growth that the company is basically driving it. In my viewpoint, I think when the volume growth and the margin growth both comes along with due to the price hike, I would think that I think that would be the sweet spot for the commodity players like SAIL. And though I agree that I think this company has always been moving in a single-digit price-earning ratio, I would like to believe that I think commodities are like this only. Probably, I think when you have the opportunity to ride the momentum, I think one could trade. And that is where I think you are getting an opportunity to trade into this particular stock at this point of time.
Okay, we'll take a quick break here. Deven stays with us. 58 points lower, 60 points lower, 18,100. So holding on to that pivot for a while now. We'll come back. We'll also have Dinshaw Irani of Helios Capital to discuss the outlook on the market. He's got some thoughts on the budget, what may not be part of it, and what it could do mean for the markets. So that conversation comes up as well. Stay with us.
Welcome back. On the way down, it's Asian Paints, which catches your attention. The stock is sold off 2.5%, post its numbers. Mangalam joins in for more. Mangalam.
Right, as far as Asian Paints numbers are concerned, it has been a top-down miss. If you just take a look at the company's volumes and value growth, both of them have been below expectations. We've seen extended rains in October impact demand for the company, and EBITDA as well as the net profit on an absolute level has been below expectations as well. What's, the better part of the numbers is the fact that there has been an improvement in margins both year-on-year as well as quarter-on-quarter. The street was expecting some moderation year-on-year despite improvement quarter-on-quarter, and the management management has said that after the weakness that we saw in October, November and December picked up really well, and December decorative growth was in double digits. But if you just take a look at the numbers as they were as against expectations, 9,500 crores on the top line is what the street was expecting, 8,600 crores is what the companies posted, and as a result of which the net profit has come in at around 1,100 crores as against expectations of 1,150 odd crores. Domestic volumes absolutely flat versus 5 to 6% growth expectations, and gross margins, while they've improved quarter on quarter, we are still to see them back upwards of that 40% level. The management said that demand picked up in November and December. That is something that the street is eyeing, whether it sustains or not. But the other part of the weakness also is in their home care business, where there was some slowdown in both their bath as well as kitchen businesses, and as a result of which there was a decline in the revenues and profitability for both those verticals as well. The stock, while it's 20% off its highs, not particularly cheap, trading at close to around 52 times FY24 earnings.
Okay, that's Asian Paints for you. And Mangalam, in the press release, they said demand has picked up in November and December, but only in the month of December, they've seen double-digit volume growth. So even November, they didn't have that double-digit growth. But you're going to be tracking HUL. Numbers should be out just as markets close. Can you walk us through the key numbers that one should look at?
Well, for HUL, there are a couple of things we'll be looking at. A double-digit revenue growth is what we're eyeing this time around, and that would be on account of mid-single-digit volume growth and about 8 to 9% sort of price hike. And that's because of the price hikes that all consumer companies have taken. 13.5% growth on the top line is what we're working with, a number just shy of that 15,000 crore mark on the revenue front. The EBITDA actually grows a tad slower than the revenue, and that's because of the inflation that we've seen as well. So while there will be a sequential improvement in margins year on year, of course, it will be lower. So we're looking at 23.6% in terms of margins. This compares to 25% the same quarter last year, but 22.9% in the second quarter. The net profit as a result of which grows in double digits as well. 10% growth is what we're witnessing or expecting out there. Volume growth of 4 to 5%. What will be important this time around more than just the numbers will be what the management has to say about demand, raw material inflation, and the acquisitions that they've made in the D2C space as well. Remember, a couple of weeks ago, they did announce the investment in Oziva and another D2C company. So those are factors that we'll be watching out for much more than just the reported numbers for HUL.
Okay, all right. Thanks a lot for that, Mangalam. So we'll wait by for HUL, but we already have Asian Paints. Deven, you heard what Mangalam had to say about the Asian Paints numbers. Well, they go down as a bit of a disappointment. We have added competition as well that's coming on stream. Valuation-wise, well, it's expensive. It's always been expensive, though. What would you do with the stock post this recent correction?
Well, I think if the corrections deepen, then definitely I think there is a buy opportunity. Largely because of few reasons. One, I think the decorative segment of paint business, where the company assumes leadership, I think is basically already seeing the traction for growth. And as a result of which, I would think that I think in subsequent quarters, they are likely to see volume-led growth coming in from the business of Asian Paint, India specific. In the neighboring countries, I think where I think their export has been affected to a certain extent, I think that probably may have resulted into some amount of fall into the numbers as far as I think exports concerned. The other two business, I think the home decor business and the kitchen business, where I think the relative contribution is small. So I'm not too much concerned about that part of it, as long as I think they're making a steady progress on that front. But more importantly, I see the prospects of company returning back to stable margins going forward, because I think in earlier quarters in this financial year, they were troubled because of, I think, the high raw material cost and I think the impact on the margins, which is possibly receding away. And that is basically going to be showing some better performance going forward. As I said, that I think if the correction deepens in the price because the valuation is steep, if it deepens in price, then possibly I think this could be a buy opportunity at lower levels.
The Asian Paints, of course, is now seeing not a big crack, but a meaningful one in terms of and all of it has come post results which are an hour and a half old. ICICI Lombard is seeing more selling pressure. I mean, after yesterday's cut, it's down another 3% or so. So, pre-results, I think the price was about 1270, and it's in 3 days flat has gotten down to 1160 kind of levels very, very quickly. ICICI Lombard, of course, I mean, the numbers were not terrible or anything, but for many, many quarters now, there has been no significant growth as well. And I think that has been a bit of a problem area. Deven, thank you very much for joining us. Good speaking with you. Appreciate you joining in with that perspective. So, just a bunch of names which we are highlighting. 60 points still lower on the Nifty, 18,100. We've got Dinshaw Irani joining us now. He's Chief Investment Officer at Helios Capital India. Dinshaw, welcome back. Great to have you on the program as always. How's the market treating you, Dinshaw? What's happening? Just tell us a little bit about what you've been doing in the market. Some underperformance relative to the globe as we begin 2023, not entirely unexpected. But tell us, what have you been doing?
So, Prashant, thank you for having me on your show, and a very good afternoon to you and your viewers. Basically, the problem is that China opening up has played a bit of an havoc, not only with India, but other emerging Asian markets also. So, China opened up in October, end October. In fact, the bottom that China hit was on 27th October, I believe. From then on, China has been up literally 50% from those levels, right? India is probably flattish to slightly negative there. So our belief is that this trade has more or less played out of opening. Maybe you'll see some reversal happening in the next couple of months back to, the flow is coming back to normal as such. And I think that's what we're playing with as such. And for us, there's another big play along the way, event along the way, which is the budget, which is going to be on the 1st of October. So that's another one which may play a bit with the market, but our belief is that it's going to be a non-event.
You're saying the China catch-up trade and the flows into China, vis-a-vis the other emerging markets, is played out completely?
So basically, what we are working with is that China was down 44% up to October. I'm talking about year to date, right? From then on, it's moved up by roughly around 48, 49. You can say 50%, right? The index is up 23, 24%. I'm talking about MSCI ex-Japan, right? So now China from the pre-COVID level, from the end of December levels is something like 16, 17% away as such. That's why we believe that, okay, that catch-up should happen in a while. India's relative, premium to China has historically been around 40, 44, 45% odd. I'm talking about pure China, right? That shot up to some 160 odd % when at the end of October, as such, rather at the bottom of China, because India didn't go down. But from there on, that premium has come down to around 80% levels. So it's almost half to those levels. So and if you look at the last 3-4 years, which is actually the COVID play panning out, I think from there on, we are somewhere like a standard deviation away from that as such. So our belief is that next couple of months, you will see this evening out, this one big market opening up, playing havoc with the flows or evening out in the next couple of months. That's our belief, yes.
Okay, all right. Hi, Dinshaw. You briefly mentioned the next event will be at the budget, but you're expecting it not to be, more or less a non-event. What are you expecting though there? And what can make it an event? Maybe on the negative side.
that we keep our fingers crossed that never happens.
True.
The negative part is obviously the capital gains taxes. The government may tinker around with the tenure of the taxes or for that matter, the rate of the taxes. But I sincerely suggest that doesn't happen because our markets are still not stabilized, and that will be a big negative. But one more thing, Nigel, that one has to keep in mind, or rather two things that one has to keep in mind is that this will be the last budget before the general elections. After that, will be a vote on account, right? So there'll be a lot of populist measures in this budget, and obviously appealing to the rural public or to the below poverty line public kind of a thing. But the hope is that there's not much allocation done. It's just sound bites, and maybe there'll be some things happening, but not too much burden on the budget. The second thing that one has to keep in mind is that FY23 was a very easy year for the government to manage their finances, because on a nominal GDP growth basis, the GDP grew at roughly around 15.5%, 16 odd %, right? So that lever is always there for the tax rates, which is obviously the tax growth rather, which is a derivative of your nominal GDP growth, to work out perfectly. But going into the next year, FY24, the nominal GDP is expected to be, whichever economics you pick up, it varies between 10 to 11%. So that lever itself has come off. And frankly, if you look at the committed expenses of the government of India, it's 70% of the revenues that they have in the kitty. So it's obvious that the lever is fairly limited. It will be a tightrope walk, but the hope is that they'll stick to the glide path that they put across in a couple of budgets back. So that's the real hope. And the third hope is that the capex focus continues, because as the FM has rightly pointed out earlier also, that the private sector has not participated as yet in the capex bit. So it has to be the state-sponsored capex which has to happen as such. And I think the sound bites are to that extent only, that the PLI schemes are being looked at more for more expenditure, newer schemes to be added. So that's the good part. So there'll be positives and negatives playing out each other. So I think that's why we call it a non-event.
You know, Dinshaw, last week I spent a couple of hours just going back and looking at, you know, what was said about each of the last 9 budgets since 2014, and you know, it's mostly been on this. It's been steady, right, consistent, and fisc has not been compromised on, balanced. And of course, I mean, then GST came, so a lot of the taxation-related items on the indirect side have all gone out. The impact lasts barely a day, 2 days. And this time, I don't think there is any movement into the budget as well. So you think one of those once again, or you think more, because this is the last full budget before the general elections. Next year, it may be a vote on account, etc. So in that sense, could it be slightly different than before?
I don't think so, Prashant. I think it will be again the same couple of days of impact, and then probably things will come back to normal. People will start looking at the fundamentals and the results gone by and start digging into them. But I mean, the negative, as I said, that it could be, if anything, it could be a negative trigger if corporate gains taxes are tinkered with. But apart from that, we don't see any major negative or positive working out. There'll be some industry-specific positives. I mean, you know that, right? I mean, in going into every budget, it's the defense sector which looks up, the railway sector looks up, and probably road constructors, they look up as such. So I think that continues. Apart from that, I don't think there's anything to play with. Yeah.
Dinshaw, pre-budget, pre-election, lots of state elections as well lined up in the next couple of months. This is the time where you see a lot of money being put into the hands of the voters, and that could drive up a lot of domestic demand, rural domestic demand perhaps. Is that a play that you would look at for the next 1 year? Because many of these stocks, although they could see some growth, valuations are prohibitive. So how would you approach that space?
So Reema, actually, if you go to see, the rural sector hasn't fired since September of 21 as such. In fact, I remember that particular call where Lever was the first one to announce that there's a marked slowdown in rural spend, and it continued well into the last year itself. In fact, now also the recovery, the little that one has seen is fairly staggered recovery. So it's a matter of time before that picks up per se. But frankly, I mean, if you actually, if you talk to the grade A cities and all, I mean, talk to the dealers out there, they're looking at a slowdown in metro spends as such. So it's obvious that both are playing out each other again. And frankly, I mean, we are worried. We are worried that this first 6 months is going to be very trying for us. I mean, first 6 months of the calendar itself is going to be very trying. You saw the results which came out, right? The good ones have already come out. And now the reactions that you're seeing are the ones which are coming out slowly with not so great numbers as such. So I think that's going to play out. And that's why our belief is that we believe that India should at least flatline from here on as such, because quite a bit has been done last year. And you need to catch up. You need to catch up with the valuations. You need to have a breather. And I think that's what we are taking a call on here. So not taking too active calls today.
All right. Thanks so much, Dinshaw, for joining in and giving us your quick view. By the way, we have more numbers that are coming about. You know, you have Polycab that's come out with a set of numbers. And I think even on this one, the wires and cables business has done very, very well. I'm just looking at the breakup. And FMEG, well, that continues to report a very mild loss out there. But bulk of their money comes in from wires and cables. And out there's a margin expansion, both on a sequential basis as well as on a year-on-year basis. And that's why the street likes that. And as I speak, the stock is up at the high point of the day, up closer around 3%, because margin expansion is something that works very, very well. Even on the top line, actually, the growth is pretty okay. But the big beat has come in on the margins front. And that's why the street likes that. Big time, big surge is what we're seeing on that one. For the time being, we'll slip into a short break. When you come back, we'll get you our buy and sell calls, technical calls coming in from our experts. Welcome back to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, as we speak, the markets have seen a bit of a recovery from the lows of the day. So that level that we pointed out earlier, 18,080, 18,075, we have gone to that level numerous times in the last 30-40 minutes itself, but we have bounced off there. And currently, we're holding at around 18,020 odd. So good move is what we've seen, at least from the low of the day, and those lower levels are getting defended. But let's get in Mitesh Thakkar. Mitesh, what do you have for a buy or a sell call for a reverse trade tomorrow?
Yeah, Nigel, one buy and one sell call. Tata Consumer is breaking down. It's near the lows of the day. It's also breaking that pivot of 743. So keep a stop at 745. Look for 730 as the target for tomorrow. And the other one is Shree Cement. That's showing some expansion on the upside. So that's a VTST kind of a call. Keep a stop at 24,250 here and look for a target of 24,650.
Right, Mitesh, thank you very much. By the way, sorry, before we let you go, any thoughts on these result reactions, Mitesh? Polycab has just come through. How are the charts looking? Havells came through earlier. Asian Paints, if you pull up the daily chart, it's kind of broken that trend line from the June lows, like many other stocks we've been highlighting. So these three names, Mitesh, quickly.
So Polycab was a call today morning. I think that remains strong and is closing with good strength. I have a target of around 2850, which is nearly met, and beyond that 2950, 2960 could be tested. Positive over there. Asian Paints, in fact, was looking like some kind of a traction on the upside yesterday, but it kind of negated that signal below 2950, and now could slide a bit more to about 2800.
Okay, and anything on Havells?
Sorry, I missed that. Yeah, Havells is also a stock, which is showing good signs, but I think it needs to clear the 200 average, which is at about levels of 1230, 1232, and we got a high of around 1224 today. I think beyond 1232, there could be a good trading continuation to about levels of 1280.
Okay, thank you very much for that. There are two IT companies whose numbers we'll be tracking post-market hours. One of them is L&T Technology and the other one is Mphasis. Now, when it comes to L&T Technology, the stock has seen a very sharp fall from its all-time high levels. The all-time high level on L&T Tech was 5,955. So from that level, the stock has fallen about 40 to 45%. And one worry is that L&T Technology plays in the engineering R&D space. And those budgets can get hit if recession hits their clients. So the visibility for ER&D spending for the next 2 years is on the lower side. That said, in the current quarter, revenue growth is anticipated to be 2%. We look at the numbers on a quarter-on-quarter basis because certain segments like plant engineering, high-tech, medical are seeing higher furloughs. L&T Technology gives you a guidance, but don't expect any change in the guidance because we just had a chat with the management, a week back, 10 days back, when they had done that acquisition of Smart World Cities from L&T. And that time we had asked the management, do you hold on to their guidance? And they said yes. So we continue to maintain that the company will hit $1.5 billion of revenues by FY25. So the guidance was reiterated by the company, so don't expect any change in that. The only point is, as we've seen with the rest of the IT companies, if there is even a little bit of a beat, the stocks are reacting positively because even L&T Tech has fallen 42% from its all-time high level. So the starting point now is a lot lower and expectations are not high because the street is baking in furloughs. So 2% is the top-line revenue growth that the street is anticipating. But that's about L&T Tech. We'll talk about Mphasis in just a bit. We've got Lata joining us in the studio. And Lata, the RBI has some big plans for digital currencies. Can you tell us what you picked up?
Actually, very interesting because, just to remind people, what was the experiment? There was a wholesale CBDC where banks could buy and sell certain GSECs and only 8 banks were chosen for the purpose. Then there was the retail. Now, in the wholesale CBDC, the banks have to have an account with the Reserve Bank, which is the only other thing you can immediately do, the interbank call market. So looks like the next project that the Reserve Bank has is that all interbank call market transactions will be done on a CBDC, on a digital currency basis. So a central clearing at the end of the day will not be needed. It can be done immediately. In the next step, it looks like they don't want to pursue with wholesale CBDC in this sense much because you have to have an account with the RBI. Now corporates, mutual funds, etc. cannot do that. So they want to tokenize the wholesale transactions also, and corporate bonds, or rather all securities they believe should be tokenized. Then you can buy and sell corporate bonds also through CBDC. You don't have to wait for the end of day or clearing through CCIL or NSE or anything like that. So that seems the next big project. So call money market and then corporate tokenization of bonds or securities. On the retail side, if you remember, 8 banks were chosen. They were allowed to do, give some customers the ability to withdraw money into a wallet and pay. Now what they want to do looks like is they want to expand it to all banks, and a temporary goal they're looking at is at least 50 lakh citizens, or 500,000 customers are able to download that wallet and do these transactions. Once it reaches that body, they feel it would become more popular and give a genuine competition to UPI. But more important than that, there is also a plan to have these digital currencies not attached to a bank account at all. See, genuinely, if you want to have it as virtual cash, I should be able to pay a person without a bank account also virtually. Looks like that is also there on the Reserve Bank's radar. So, you may have a card or, a Fire Stick like you have for Amazon. It can be loaded with cash. And so, you just touch a gizmo to a gizmo and it should be able to transfer cash. That would be truly anonymous because it will not be linked to a bank account. That is also in the game plan of the Reserve Bank. That's what sources tell us. Well, I cannot give you a timeline, but this is the thinking in the central bank as what banking sources tell us.
Thanks very much. Digital, physical, I mean, just more money.
No, I think that'll be very interesting.
We accept all kinds of
cash. No, but I was quite kicked by it. That,
no, absolutely.
See, even in a time in a village where you don't, or village why, in a highway where there is no power or internet, if I can transfer money by putting my mobile to somebody else's mobile, I think that would be a great invention if it happens.
Absolutely. Well, we'll keep track and get you more as we go along. Well, 62 points lower, 18,102 is where we are at right now. Rima, those Mphasis expectations you want to run us through in terms of what we're watching?
Well, yes. So when it comes to Mphasis this time, now Mphasis for one has underperformed the IT pack, right, in the last 1 year. So in the last 1 year, Mphasis stock price is down 36%. The Nifty IT is down 22%. The reason for the miss is the company has a high exposure to the mortgage business. Mortgage business, the refinancing, the volumes come down when interest rates are higher. When interest rates are coming down, you will go from one bank to another bank saying, lower my, I'm going to come to you because you're offering me a lower interest rate. So my EMIs come down. So when interest rates go up, the mortgage business gets hit, and therefore the IT work, because these companies process those mortgage applications, right? So revenues get hit. So Mphasis has an exposure to the mortgage business. And two, it also has an exposure to a high-tech client, which the company last quarter told us that they are seeing higher furloughs. So which is why Mphasis revenue growth has been muted. Even last quarter, the revenue growth was just 1.8%, when peers had reported a 3, 4, 5% type of revenue growth. And this quarter, we're working with a 0.3% growth. But now, because Mphasis is underperformed, its valuations are cheaper than peers. Forward multiple, FY24, if you pull up the valuation plate, Mphasis trades at 20 times, whereas peers like LTI, Mindtree, Coforge, Persistent are far more expensive. And we've seen in the case of Persistent, right, it's the most expensive in the mid-cap IT pack. Yet the stock raced away when there was an earnings beat and the commentary was bullish. So the starting point for Mphasis, given its underperformance and hence cheaper valuation, is a lot more attractive. So we'll be watching out for this one.
All right, that's a well-tracked name, and those are expectations which are coming through right now. Polycab, I mean, keep an eye. It's up 3%. It's coming up. I mean, it's come off a little bit from the highs, but not very much. The other was Asian Paints, which is still down about 2.5. Not quite at the day's low, but almost there. And then we had Havells, which is right in the middle of the day's trading range. Havells high was 12.23, low was 11.88, and we are somewhere in the middle right now. Neeraj Devan, director at Quantum Securities, is with us. Neeraj, good to have you with us here. Out of these three, the clear disappointment is Asian Paints. Numbers are almost 8% miss on EBITDA. Do you think it'll see earnings downgrades? FY24 numbers will be brought lower.
Yeah, good afternoon. I think so because there are a couple of reasons. One, of course, the results were not good, and second is that there's a lot of competition intensity which going to come in this sector in the next a year or so, year or 2 years. So that also will weigh on people's mind. So there can be some earnings downgrade there because the stock is not cheap. So it's available. It's still trading at a very high valuation. So I think there is a possibility of some downgrade.
All right. Hi, Neeraj. Good afternoon. Neeraj, I want to ask you about the Vedanta Group companies. Now, anything is possible out there. We have Hindustan Zinc that comes out with its set of numbers today. Both these two stocks, well, they have moved to the high point of the day. That is Vedanta and Hindustan Zinc. And you can't rule out anything with regard to these companies. Now, I want to know what's your view out there. I'm not sure whether the street is sensing there could be a big dividend, that's going to be coming about. That's point number one. The second factor is, they have been toying with the idea of shifting all the zinc assets to Hindustan Zinc. So will that happen? If that happens, then Vedanta gets some money. So it'll be interesting to see whether or not that happens. And we have asked the management numerous times on the channel as well. Is that going to happen? They've said they've toyed with the idea. For the time being, just take a look at that. Both those two spiking up. So there's just two thoughts that come to my mind. We'll know in the next couple of hours. But Neeraj, what's your sense? The Hindustan Zinc numbers are expected to be subdued. But the way the stocks are moving, it appears the street is sensing something. Your view on them?
Yeah, actually, purely on Vedanta, because I've been following valuation-wise Vedanta. If you compare it to other, non-ferrous plays, Vedanta is available at a decent valuation. It's even after the move that we've seen post that failed, buyback and the failed delisting. Even after the move, it's almost 3 times on that level. But still, it's available at a very good valuation. And even at this price, I think one can make a case for a valuation-led upside potential in Vedanta. So that's why I still think that Vedanta should be one stock which can be part of the portfolios. And of course, Hindustan Zinc numbers will determine if the dividend can be higher. Or other point that you're mentioning about zinc, assets moving to Hindustan Zinc, that's too premature for us to say right now. We need to wait if some news comes from that part. But purely on valuation, I think Vedanta is definitely an investment stock.
Okay, this is not playing out like a typical expiry, right? The last 1 hour has been very, very flat. We've just been static at that 18,100 mark. We're down 61 points, so we've snapped a 2-day winning streak. The Sensex is down 200 points, but as you can see, in the last 30 minutes, there hasn't been too much turbulence in the markets. Getting into a short break, we'll come back with more market talk.
Okay, welcome back. Things are looking a little down, 70 points lower, 18,095. I mean, the market has not been able to do very much with the pullbacks it has had along the way, and there have been multiple pullbacks, attempts at pullbacks, but never really went anywhere. And we're going to kind of sort of end with slightly weaker kind of picture. Rallis India started lower 5%. It's going to end down almost 9% in the red. And I think market breadth is also deteriorated as we come towards the final closing minutes. You track this one, Rallis India, Neeraj? Any thoughts?
No, I don't track Rallis India.
Okay, you don't track Rallis India. The other sort of big mover, I mean, actually not the big mover, but something to keep an eye out has been Sula all day. Recent listing, yesterday was up 6%. Today for most of the day has been strongly higher, 4-5%. But there is a bid there. I mean, at lower levels, you can very clearly see it suddenly starts to get bid up once again. So keep an eye on that one. It's now about 15% higher than where it listed not very long back. Neeraj, thank you very much. Good speaking with you. Appreciate you joining in with that perspective. I think it's time to wrap up things as well. So we got a 75-point cut on the Nifty. I think we'll have the Nifty Bank as well come up for you, which is going to be down about, what, 1/3%. So Nifty Bank did a little better than the Nifty. Nifty down 0.4. We had the Nifty Mid-Cap Index, which is going to end down slightly. And the small caps were a little more weaker. A full 0.5% cut is what we had. Otherwise, in terms of sectoral kind of performance, cuts coming through in the media index, which was down 1%. FMCG was down 1%. and you had the energy index, which was down about 0.5% or so. Nothing very large, but lots of stuff which was under pressure. Rima.
Well, Asian Paints down 3% by the close of trade. IndusInd Bank sold off despite the numbers looking good. Kotak Mahindra Bank was under pressure, a cut of nearly 1.6%. On the flip side, HDFC Bank continues to see buying interest. HDFC Bank gaining close to about 0.2%. For the week, HDFC Bank has gained close to about 2.5%. The top 3 percentage gainers on the Nifty include Coal India, UPL and ONGC, and add BPCL as well. Apart from that, on the earnings reaction on the way down, you had rallies selling off very sharply. Adani Enterprises, where the FPO will be opening next week. In fact, the weakness in Asian Paints rubbed off on Berger Paints. So Berger Paints was down close to about 2%. On the gaining side, Persistent Systems was the big winner, and Goa Carbon too. The final tick on the Nifty is below 18,100. It's 18,084, 81 points lower on the Nifty. The Sensex down 261 points. We're awaiting numbers from HUL. The press conference is scheduled at 4:15 p.m. So we'll be getting the numbers in the next 30 minutes. It's a wrap and closing bell. Don't go anywhere. Our very special conversation on the importance of gender parity coming up next.